In this video, we're going to raise a very important question that every investor should ask. Can my portfolio adapt to the markets? As an investor, 2025 has been a very chaotic year. You've seen markets go through a drawdown period in the first few months of the year, and this came in from a weak 2024 close as well. Beyond that, you've seen a more or less flat movement in markets in the last 1 year. You've also seen lower levels of volatility, continuous domestic institutional investor participation, and FIIs have been pulling out money. You've gone through a lot of ups and downs in terms of tariffs, AI, and a whole host of other global factors. We've been combating slow growth. We've been looking at lower inflation and a shift in monetary policy, as well as global policy divergences across the board. So in such a context, there are a lot of moving parts which could be affecting your portfolio. As an investor, this question allows you to think about how your portfolio can adapt to whatever's going on across the world. So to have a portfolio that is adaptable, you actually need three qualities. You need a portfolio that's resilient, you need a portfolio that's stable, and you need a portfolio that can be opportunistic as well. So how do we get these three things into place? Let's start with resilience. When you have a resilient portfolio, what you actually need is to invest in high quality businesses that have very strong balance sheets. This will ensure that these businesses can actually weather any kind of financial, geopolitical, or other type of storm. A strong balance sheet ensures that a company is well capitalized even in the worst of times. It also ensures that a company has a healthy financial score, which could tide you through even more challenging times in the market. When you invest in high quality companies, you're also relying on managements that can handle challenges in an effective and constructive manner and can bring these companies out on a stronger wicket through tougher times. So paying attention to both quality as well as balance sheet health could be the way to build a resilient portfolio. When we talk about stability as a pillar of portfolio growth, what you actually need is a portfolio that doesn't move too much up and down beyond your comfort range. Now, each of us have different tolerance levels, and assessing your own tolerance level through a risk profiling test and then comparing it to the products that you own and seeing whether your comfort in terms of drawdown actually aligns with what these portfolios go through in challenging times is an important metric in assessing how much risk you can actually take. A stable portfolio is one that has an asset allocation mix that suits you. So keeping some money in cash if you want to take a cash call makes sense. Otherwise, having an overall asset allocation which allows you to laterally shift from one asset to another asset at the right time or towards the right opportunity would be a great way to create portfolio stability. To increase stability in a portfolio, you could look at adding more stable assets like fixed income or cash to ensure that even if one part of your portfolio is fluctuating due to market movements, the other part allows you to have that cash buffer and grow and compound at a steady rate, or that allows you to participate in these opportunities that may come up in the future. The third way that your portfolio can adapt to markets is by being more opportunistic, which means we need to break away from this mentality that performance is proof of a product, because past performance only tells us what the product has done in the past. It doesn't indicate anything about what the product or the investment can do for you in the future. Many times the past may look quite bleak, the present may look a little bit uncertain, and the future might look bright. So as an investor, you need to be able to break these three phases and see where you're heading and create a portfolio that is more forward-looking. Your continuous contribution in the market would also help you participate in these futuristic opportunities. So you can build a portfolio that adapts to markets by following these three principles: building a portfolio that is resilient, keeping your portfolio stable, and maintaining an opportunistic outlook towards new investments that you're going to make. If you get these three things right, you'll be very successful as an investor. And if you'd like to do it the Ithought way, you can get in touch with us at 9500027285.